CrimeVerse presents Case File 001. Bernie Madoff. Financial fraud. Imagine spending your entire life building a future you believed was secure. Years of careful saving, retirement plans, college funds for your children, charitable donations made with the hope of changing lives. Then, almost overnight, everything disappears. Not because of a stock market crash alone. Not because of a natural disaster. But because the person you trusted most with your money had never been investing it the way you believed. In December 2008, that nightmare became reality for thousands of investors around the world. Families watched decades of savings vanish. Charities faced devastating losses. Businesses struggled to survive. Even experienced financial professionals were left asking the same question. How had this happened? The answer pointed to a man whose name had become synonymous with success on Wall Street, Bernard L. Madoff. To many, he represented experience, stability, and credibility. His firm had operated for decades. He had earned respect throughout the financial industry. He had even served as chairman of the Nasdaq Stock Exchange during its early years. If someone like Bernard Madoff couldn't be trusted, then who could? That question would become the center of one of the largest financial crime investigations in American history. What makes this story remarkable isn't simply the enormous amount of money involved. It's the extraordinary level of trust that surrounded the man at its center. Investors didn't believe they were taking reckless risks. Many believed they had found one of the safest places possible to protect their wealth. Some were introduced by close friends or family members. Others were referred by respected financial advisors. Every new recommendation reinforced the illusion that this investment operation was legitimate. As investigators later uncovered the truth, they discovered that the fraud had survived not because it was impossible to detect, but because reputation often proved stronger than skepticism. Warning signs existed. Questions had been raised. Yet year after year, the image of success continued to outweigh the doubts. So how did a respected Wall Street figure convince so many intelligent people, including experienced investors, business leaders, charities, and financial professionals, to trust him for decades? Why did repeated warnings fail to stop what was happening? And what finally exposed a scheme that had remained hidden for so long? This is not simply the story of Bernard Madoff. It is the story of trust, deception, overlooked warning signs, and the investigators who eventually pieced together the truth behind one of history's most infamous financial frauds. To understand how it all unraveled, we first need to understand the man everyone believed they already knew. Long before his name became associated with one of the largest financial frauds in history, Bernard L. Madoff was known for something entirely different: credibility. Born in New York in 1938, Madoff entered the financial world at a time when Wall Street was changing rapidly. In 1960, he founded Bernard L. Madoff Investment Securities, a firm that began modestly but steadily expanded over the following decades. As technology transformed financial markets, Madoff's company earned a reputation for innovation and efficiency. Industry peers regarded him as a knowledgeable professional, and his influence continued to grow. That reputation wasn't limited to his own clients. Madoff became a respected figure within the securities industry and even served as chairman of Nasdaq during its formative years. To many observers, that role symbolized experience, leadership, and integrity. His name carried weight. In the financial world, reputation is often one of the most valuable assets a person can possess, and Bernard Madoff appeared to have earned his. What made him especially attractive to investors wasn't flashy marketing or extravagant promises. In fact, many people described him as calm, disciplined, and remarkably consistent. While others chased headlines with bold predictions, Madoff projected stability. His reported investment returns appeared positive year after year, even during periods when financial markets were experiencing volatility. For investors who feared uncertainty, consistency felt reassuring. Another factor strengthened his image: exclusivity. Unlike firms that openly advertised for new business, access to Madoff's investment advisory operation often seemed limited. Prospective investors frequently believed they needed a personal introduction or referral before they could become clients. That perception created an unusual dynamic. Instead of Madoff appearing eager for investors, investors often felt fortunate if they were accepted. Psychologists have long observed that scarcity can increase perceived value. When something appears difficult to obtain, people may assume it must be worthwhile. Whether intentional or not, that sense of exclusivity contributed to Madoff's reputation. Existing clients recommended him to friends, relatives, colleagues, and charitable organizations. Each successful referral reinforced the belief that countless others had already done their homework. Trust spread quietly, one recommendation at a time. As the years passed, billions of dollars flowed into the investment advisory business. Families entrusted retirement savings. Charitable foundations placed funds under his management. Businesses, professionals, and experienced investors joined the growing list of clients. Many believed they weren't simply investing with a successful money manager. They believed they were investing with one of the safest names on Wall Street. But beneath that carefully maintained reputation, questions were beginning to emerge. Not everyone accepted the numbers at face value. A handful of analysts studied Madoff's reported performance and reached a troubling conclusion. The returns appeared unusually steady. In a world where markets constantly rise and fall, the consistency itself seemed difficult to explain. Most investors never saw those concerns. They continued receiving account statements that appeared to confirm everything was working exactly as promised. Behind the scenes, however, a few people had started asking the question that would eventually change everything. What if the success everyone admired wasn't real at all? By the late 1990s, Bernard Madoff's reputation seemed stronger than ever. Investors continued recommending him to friends and family. Financial professionals spoke of him with respect. His clients received statements showing remarkably steady returns, regardless of whether markets were rising or falling. To many people, that consistency was reassuring. To one experienced financial analyst, it was deeply troubling. His name was Harry Markopolos. Unlike most investors, Markopolos wasn't impressed by Madoff's reputation. He was interested in something much more important: the numbers. As part of his work, he examined investment strategies and tried to understand how money managers achieved their results. When he looked at Madoff's reported performance, he noticed something that didn't seem to fit. The returns appeared unusually consistent. Financial markets are unpredictable. Even the world's most successful investors experience losing periods. Yet Madoff's reported results seemed to avoid the kinds of fluctuations that professionals would normally expect to see over long periods. Markopolos began asking a simple question: how could one investment strategy produce returns that looked so stable through changing market conditions? The more he studied the available information, the more concerned he became. He attempted to recreate the strategy that Madoff claimed to be using. Again and again, his calculations led to the same conclusion. The reported performance appeared extremely difficult, if not impossible, to achieve using the publicly described approach. This wasn't proof of fraud, but it was enough to justify serious questions. Believing regulators should investigate further, Markopolos submitted detailed analyses to the U.S. Securities and Exchange Commission, commonly known as the SEC. His reports explained why he believed Madoff's reported investment results deserved closer scrutiny. Those warnings would become one of the most discussed aspects of the entire case. Over the following years, additional concerns surfaced from other sources as well. Yet Madoff's reputation remained largely intact. Investors continued to trust him. New money continued to enter the business. The account statements kept arriving, showing the same pattern of reassuring returns. To many observers, the absence of public action reinforced confidence rather than suspicion. If something were truly wrong, surely someone would have stopped it. That assumption turned out to be one of the most powerful forces keeping the scheme alive. Years later, reviews of the case would conclude that regulators had multiple opportunities to uncover the fraud earlier. Investigations were conducted, questions were asked, but the full truth remained hidden. The reasons were complex, involving missed opportunities, incomplete examinations, and failures to connect critical pieces of information. Meanwhile, Madoff's operation continued to grow. The longer it survived, the stronger the illusion became. Each successful year convinced more people that the system was working exactly as promised. But beneath the appearance of stability, the foundation was becoming increasingly fragile. The operation depended on one thing above all else. People had to keep believing. And in 2008, that belief would face its greatest test. For years, Bernard Madoff had built a reputation on one simple promise: consistency. While other investors worried about market crashes and unpredictable swings, his clients opened their account statements and saw something different. Month after month, year after year, their balances appeared to grow with remarkable stability. It looked like proof that Madoff had discovered an investment strategy that others simply couldn't match. In reality, investigators would later uncover a very different story. To understand what happened, it's important to understand one basic idea. In a legitimate investment business, money is placed into investments that can rise or fall in value depending on market conditions. There are good years and bad years. Profits are never guaranteed, and even experienced professionals cannot eliminate risk entirely. Ponzi scheme works differently. Instead of generating genuine investment returns for clients, money contributed by newer investors is used to pay earlier investors who request withdrawals. As long as enough new money continues flowing into the operation, and not too many people ask for their money back at the same time, the illusion can continue. On paper, it appears that investments are performing well. Behind the scenes, the system depends on a constant flow of new funds. According to investigators and court filings, that was the foundation of Bernard Madoff's investment advisory business. When new clients joined, they believed their money was being invested according to the strategy they had been told about. They received account statements showing purchases, sales, profits, and growing balances. Those statements looked professional. They appeared detailed. To many investors, they confirmed exactly what they expected to see. But investigators later determined that many of those reported trades had never actually taken place. The account statements created the appearance of successful investing, even when the underlying transactions did not exist as represented. The longer the operation continued, the more convincing it became. Satisfied investors rarely complained. Some withdrew money and received it without difficulty, strengthening their confidence. Others recommended Madoff to friends, relatives, business partners, and charitable organizations. Every successful referral brought new money into the system, helping maintain the illusion. Trust became the engine that kept everything moving. Ironically, Madoff's reputation often reduced the number of questions people asked. Clients who trusted him completely were less likely to demand detailed explanations or independently verify every aspect of their investments. Confidence replaced skepticism. For years, that confidence proved powerful enough to keep the operation alive. But beneath the surface, one serious weakness remained. The entire structure depended on stability. It depended on investors remaining calm. It depended on withdrawals staying manageable. And most importantly, it depended on enough new money continuing to arrive. If those conditions changed, the illusion would become impossible to maintain. That moment arrived in 2008. The global financial crisis shook markets around the world. Investors who had once been content to leave their money untouched suddenly needed cash. Some wanted to protect what they believed remained of their savings. Others simply needed liquidity during an uncertain economic period. Withdrawal requests increased. For an ordinary investment firm, that would present a difficult challenge. For a Ponzi scheme, it was catastrophic. The system had reached the point where promises could no longer keep pace with reality. For decades, Bernard Madoff had successfully protected the illusion. Now, for the first time, the illusion was beginning to collapse. And once it did, investigators would discover that one of Wall Street's most trusted names had been hiding one of history's largest financial frauds in plain sight. By the autumn of 2008, the global financial system was under extraordinary pressure. Major financial institutions were failing, stock markets were experiencing historic volatility, and confidence in the banking system had been shaken. Around the world, investors who had once focused on growing their wealth were now focused on protecting what they had left. Bernard Madoff's clients were no different. Many began requesting withdrawals from their accounts. Some wanted to move their money to what they believed were safer investments. Others needed cash to cover business expenses, retirement costs, or family obligations during an increasingly uncertain economy. For years, those requests had rarely posed a problem. Now they arrived in waves. According to later court records and public accounts, the investment advisory business simply did not have the money that clients believed was waiting for them. The account balances shown on statements did not reflect actual investment assets capable of meeting the growing demand for withdrawals. The illusion that had survived for decades was now facing a problem it could not overcome. Every new withdrawal increased the pressure. Every day without enough incoming money made the situation worse. For the first time, there was no realistic path to keeping the scheme alive. In early December 2008, Bernard Madoff reportedly told members of his family that the investment advisory business was, in his words, one big lie. According to court records and later testimony, this private admission marked the moment when the truth could no longer be contained. Faced with that confession, family members contacted legal counsel, and shortly afterward, federal authorities became involved. On the morning of December 11, 2008, agents arrived at Madoff's Manhattan apartment. The investigation that had been building for years was no longer a theory. It had become a criminal case. Madoff was arrested and charged with securities fraud. News of the arrest spread rapidly across television networks, newspapers, and financial markets around the world. Within hours, the story dominated headlines. For thousands of investors, the shock was almost impossible to process. Many initially believed there had been a misunderstanding. Others expected that the missing money would eventually be found. Some continued hoping that the investment statements they had trusted for years represented real assets waiting to be recovered. As investigators began examining the firm's records, that hope faded. The scale of the deception was becoming clearer. Families realized retirement savings had vanished. Charitable foundations discovered that funds supporting scholarships, medical research, and community programs were gone. Businesses faced severe financial losses. People who had spent decades carefully planning for the future suddenly found themselves starting over. The collapse of Bernard Madoff's operation wasn't just the downfall of one man. It became one of the most significant financial crime investigations in modern history. But an even more difficult task was only beginning. Investigators now had to answer a question that would take years to unravel. How had this operation managed to survive for so long, and what evidence would finally reveal the full extent of the fraud? When Bernard Madoff was arrested on December 11, 2008, the headlines traveled around the world within hours. For many people, it appeared that the mystery had been solved. In reality, investigators believed their work had only just begun. An arrest answers one question. A criminal investigation must answer hundreds more. How much money had actually been lost? Who had invested? Where had the money gone? Which transactions were legitimate? Which records had been fabricated? And perhaps the most difficult question of all, how had this operation remained hidden for so many years? To answer those questions, investigators, forensic accountants, federal prosecutors, regulators, and court-appointed specialists began one of the largest financial reconstruction efforts in American history. Boxes of financial records were collected. Computer systems were examined. Bank accounts were traced. Trading records were compared against statements that clients had received over many years. Investigators quickly discovered that the paperwork presented to investors told a story that did not match reality. Many account statements listed trades that investigators determined had never occurred as represented. Purchase dates, sale dates, prices, and profits appeared on official-looking documents, creating the impression that investments had been carefully managed through changing market conditions. But when investigators compared those records with actual market activity, serious inconsistencies emerged. The documents looked convincing. The underlying transactions often did not exist in the way clients had been led to believe. That discovery became one of the strongest pieces of evidence in explaining how the fraud operated. At the same time, investigators interviewed employees, investors, and others connected to the business. Each interview added another piece to the timeline. Some employees described highly compartmentalized responsibilities, where different parts of the business operated separately and information was tightly controlled. Others explained that they had limited visibility into the investment advisory operation itself. The investigation also highlighted another important lesson. Reputation had become a substitute for verification. Many investors had trusted Bernard Madoff because respected friends, relatives, business associates, or financial professionals trusted him first. Recommendations spread through personal relationships, creating a powerful cycle of confidence. The fraud did not survive because every warning sign was invisible. It survived because trust often discouraged deeper questions. As investigators continued assembling the evidence, the legal process moved forward. In March 2009, Bernard Madoff appeared in federal court and pleaded guilty to 11 felony charges, including securities fraud, wire fraud, mail fraud, investment advisor fraud, money laundering, false statements, perjury, theft from an employee benefit plan, and making false filings with the SEC. There would be no lengthy criminal trial debating whether the fraud had occurred. The guilty plea confirmed responsibility. Several months later, on June 29, 2009, a federal judge sentenced Bernard Madoff to 150 years in prison, the maximum practical sentence available under the law. During sentencing, the court emphasized the extraordinary scale of the deception and the devastating harm suffered by thousands of victims. Yet even after the sentence was announced, another enormous challenge remained. The prison sentence could not restore retirement savings. It could not immediately rebuild charities that had lost funding. It could not replace years of financial security that had disappeared. The next phase of the story would become one of recovery. Court-appointed trustee Irving Picard and his team began the painstaking process of locating assets, pursuing legal claims, negotiating settlements, and recovering money for victims wherever possible. That effort would continue for years, eventually returning billions of dollars to customers, though many victims could never be made completely whole. The investigation had exposed the truth. The courts had delivered justice. But for thousands of families, the consequences of the fraud would continue long after the headlines faded. And those human consequences would become the final and most important chapter of the CrimeVerse investigation. When people hear the words billions of dollars, the number is almost too large to imagine. But financial crime is never just about numbers. Behind every account statement was a person, a retired couple who believed they had finally secured a comfortable future. Parents saving for their children's education. Small business owners who had spent decades building their companies. Charitable foundations supporting medical research, scholarships, hospitals, and community programs. Many of them had made careful financial decisions throughout their lives. They weren't chasing impossible returns or reckless speculation. They believed they had placed their savings with someone whose reputation had been built over decades and whose name was respected across Wall Street. When the fraud collapsed, the emotional damage reached far beyond bank accounts. Some families postponed retirement indefinitely. Others returned to work after believing their careers had already ended. Charitable organizations reduced programs, delayed research projects, or closed entirely because expected funding had disappeared. For many victims, the hardest part wasn't only losing money. It was losing trust. People who had recommended Bernard Madoff to friends or relatives often carried a deep sense of guilt, even though they had been deceived themselves. Relationships were strained. Lifelong friendships were tested. Families struggled to understand how something that appeared so legitimate could have been built on falsehoods. The investigation revealed another important lesson about financial crime. The victims came from many different backgrounds. Some were wealthy. Others had invested modest life savings. Some understood financial markets. Others relied almost entirely on professional advice. Fraud does not always target people with little knowledge. Sometimes it succeeds because it earns the confidence of people who believe they have already done their homework. In the years that followed, the court-appointed trustee worked to recover as much money as possible for victims. Through settlements, lawsuits, and asset recovery efforts, billions of dollars were eventually returned to former customers. Those recoveries represented years of determined legal work. For many victims, they provided meaningful financial relief. But recovery could not erase every consequence. Time lost could not be recovered. Opportunities missed could not always be replaced. And for many families, the emotional impact lasted long after financial settlements were reached. The Bernie Madoff case became one of the clearest reminders that financial crimes rarely end when an arrest is made or a sentence is handed down. Their effects can continue for years, sometimes for generations. As investigators, regulators, and financial institutions examined what had gone wrong, one final question remained. Could a fraud of this scale happen again? The answer would shape reforms, influence future investigations, and leave lessons that continue to matter today. On June 29, 2009, Bernard Madoff was sentenced to 150 years in federal prison. For many people, the case appeared to be over. The man responsible had admitted his crimes. The investigation had exposed the fraud. The courts had delivered justice. But the story didn't truly end there. The collapse of Madoff's investment advisory business forced regulators, financial institutions, investors, and investigators to confront uncomfortable questions about how such a massive fraud had remained hidden for so long. One lesson became impossible to ignore. Reputation is not evidence. For years, Bernard Madoff's credibility had opened doors that few people questioned. Investors trusted him because respected friends trusted him. Financial professionals trusted him because of his standing within the industry. Organizations trusted him because others already had. In many cases, confidence replaced verification. Another lesson involved consistency. Experienced investigators and financial analysts often point out that every investment strategy carries some degree of risk. Markets rise, markets fall. Even highly successful investors experience periods of poor performance. Returns that appear unusually smooth over long periods deserve careful examination, not automatic admiration. The Madoff case also highlighted the importance of independent oversight. Questions had been raised before the fraud collapsed. Analysts had expressed concerns. Examinations had taken place. Yet the full picture remained hidden until the financial crisis placed extraordinary pressure on the operation. Following the collapse, regulators reviewed their own procedures, and the SEC made significant changes aimed at improving the way complex investment advisors are examined, how tips are handled, and how potential fraud risks are identified. The case also changed the way many investors think about due diligence. Today, financial advisors frequently encourage clients to understand where assets are held, who serves as the independent custodian, how investment performance is verified, and whether claims can be supported by independent documentation. These questions cannot guarantee safety, but asking them can reduce risk. Perhaps the most enduring lesson from the Madoff case is that fraud often grows in the space between confidence and verification. Trust is essential in every financial system. Blind trust is not. Years after the headlines faded, the Madoff investigation continues to be studied by regulators, universities, law enforcement agencies, and financial professionals around the world. Not simply because of the enormous financial losses, but because it revealed how deception can survive when reputation goes largely unquestioned. The story of Bernard Madoff is no longer just the story of one man. It is a case study in human psychology, institutional oversight, financial crime, and the importance of asking difficult questions even when everyone else seems convinced that everything is fine. Here at CrimeVerse, we believe every major investigation leaves behind more than evidence. It leaves behind lessons. Because understanding how these crimes happened is one of the best ways to recognize warning signs in the future. If this investigation changed the way you think about trust, reputation, and financial crime, there is another case you need to see. It tells the story of a revolutionary healthcare company that promised to transform medicine, attracted billions of dollars in investment, earned the support of world-famous business leaders, and ultimately became one of the most notorious corporate fraud cases of the 21st century. That investigation is our next CrimeVerse documentary. Until then, remember, every crime has a story. Every story leaves evidence. We'll see you in the next investigation.